Thank you all so much for being here today. And Catherine, thank you for being here and leading us in this topic that we've talked about through the Finance Committee and through Endowment Committee, and really should be and will be very useful for many of us. So let's start with a word of prayer, and then Catherine will take us through her presentation. Holy One, we give our all to you, mind, body, and spirit. And we give our resources to you. And we pray that you will shape our offering into something that yields fruit for your kingdom. In Christ's name we pray. Amen.
Amen. So thank you. Good morning.
Good morning.
I think I know everybody in here, but I am Catherine Birkenpass, and I'll tell you a little bit about myself and my career, and then we'll get started. I'm a certified financial planner. My career has always been about financial planning, financial education, and operations. So they told you that I work at Morgan Stanley and I'm a financial advisor. I'm not technically a financial advisor, but that is easier to say and kind of get across to you quickly what I do. I'm a financial planner, so I help financial advisors get financial plans in place for their clients. And I run a team of operations, right? So I kind of know how all the things work behind the scenes. I worked for 15 years at a company in Washington, D.C., used to be called ICMARC, now it's called Mission Square Retirement. I ran their financial planning services and did a lot of financial education. And I moved to Morgan Stanley 3 years ago, and I help advisors get clients' financial plans in place, and I run a team of operations. So my mom has a financial advisor, and it seems like I work with her financial advisor in spurts. And whenever I call, I say to him, your team has got to be so confused why Morgan Stanley is calling you. They're probably thinking I'm, a recruiter who's trying to recruit you. So we're going to talk today about charitable contributions, and the big moral of the kind of Cliff Notes version of the presentation is how you can make a charitable contribution and reduce your taxes. So it's a win-win, right? So charitable contributions and saving on taxes instead of, writing a check. You can always write a check and make a cash donation, but these are a couple of strategies that also help you save money in taxes. So we're going to talk about it was working.
Does it work? Yeah, just click on it.
Once it gets started.
Yeah. Okay, now try.
Perfect. Yes, excellent. Thank you. So we're going to talk about two main strategies, qualified charitable distributions, which I will very often call QCDs, and gifting appreciated stock. And when I say stock, that word fits really well in a PowerPoint because it's really short. You could also put in mutual fund or investment, right? So stock's kind of a placeholder word for any investment. So qualified charitable distributions is where we'll get started. But before we can talk about those, we really need a little bit of background information, right? So let's talk about required minimum distributions, another acronym, an RMD, right? So a required minimum distribution is a very specific amount of money that the IRS tells you have to take out of a tax-deferred retirement plan once you reach a certain age. And typically these are traditional IRAs, 401ks, 403bs, any employer-sponsored retirement plan, simple IRAs, SEP IRAs, not Roth IRAs. Nothing with the word Roth in it it has a required minimum distribution. So the reason for this is because, a lot of people work for a job that has a retirement plan and they put money into the retirement plan pre-tax. So Uncle Sam didn't get any tax money, and it grows and it grows and it grows and it grows. And at some point, Uncle Sam, right, wants some tax money. So that's why Uncle Sam says at some point you have to start taking at least a little bit out of that retirement plan so we get some tax money. So the calculation is the ending account balance from December 31st of the previous year divided by an IRS life expectancy factor, and that equals your required minimum distribution for the year. So if we look at an example, the IRS absolutely is not trying to make you spend all of your retirement money. They're just trying to turn the tap on to some tax revenue, right? So if we take, somebody that's age 74, and I picked the age 74, so this person was already taking required minimum distributions. That's not the start age. Let's say they have $500,000 of savings in a 401k or a traditional IRA. They're 74, the IRS life expectancy factor for a 74-year-old is 25.5. So that means they would have to take out of that retirement plan $19,607 for that tax year. And that, right, is about 3.9% of the balance. So I'm telling you the percentage just so you know, it's not to make you spend all of your retirement savings. And then I just gave that retirement plan a 6% growth rate along with that distribution. So you could see that your retirement plan would still grow, right? It's not being depleted. All right, so before 2019, the start age for required minimum distributions was age 70 and a half. It's a weird age, right? Yeah. Why did they pick the half year? I always think of some congressperson was 70. Right? And then qualified charitable distributions, you were also able to start at 70 and a half. So the two were started hand in hand in partnership, right? But then the good old Secure Act came along, and the Secure Act 1.0 in 2019 pushed out the RMD age, so you didn't have to take required minimum distributions until age 72. I don't know if they forgot or didn't care or didn't want to, but the start age for qualified charitable distributions didn't change. Still 70 and a half. Well, then the Secure Act 2.0 in 2023 pushed out the RMD age even further, and nobody has touched the qualified charitable distribution age of 70 and a half. And the reason that I think that's important is because it made a lot more sense when the two ages were exactly the same. Mm-hmm. It was easier. And now it's great that you don't have to start taking required minimum distributions until later. You always can take distributions when you're retired, right? But the QCD age is still 70 and a half. So now it's a little more complicated. All right. And oftentimes I get the question of, what if I don't want to take the required minimum distribution? What if I don't want that money? So you can always do three things with a required minimum distribution. You can always invest it. So you take the money out of the retirement plan, Uncle Sam gets his bite of the money, and you could invest it in a taxable brokerage account, right? You don't have to spend it. You can spend it. So if that money supports your lifestyle in retirement, spend it, right? Or you can gift it. And an option for gifting is a qualified charitable distribution. There's two main nuances to how you do a qualified charitable distribution, which is why we're talking about it. Because what you would normally do is take your RMD, have it direct deposited into your bank account, and then you would decide if you're going to invest it, spend it, or gift it, right? You just gift it from your checking account. But with a qualified charitable distribution, it needs to be pre-thought about. So we'll get into the specifics there. All right, so how do QCDs work? You can make qualified charitable distributions of up to $105,000 for 2024, right? So up to $105,000 can be considered qualified charitable distributions, and you can do any amount less than that. That's actually really hard to see with those colors. So a QCD donor has to be age 70 and a half, or you can't use this strategy yet. If the donor is over the age of 73, it can count toward the required minimum distribution. So in the example that I gave you, the individual had a distribution of about $19,000. They could say, I want to do a QCD of $15,000, right? You can pick any amount you want to. The QCD has to go from the custodian to the charity, the church or the charity, wherever you're going to donate it. It cannot go from the custodian to your bank account and then you write a check. So the custodian is Fidelity, Vanguard, Charles Schwab, Merrill Lynch, Morgan Stanley, Wells Fargo, just an independent financial advisor, right? So
Raymond James.
Raymond James, yes, thank you. Your bank, your credit union. All of these custodians have a form. If you call and say, I want to do a QCD, they'll say, oh, great, we'll give you a form. Or you can log into your account online and type in the search field QCD and you'll get a form, but the money has to go directly from the custodian to the charity or church. If it goes to your pocket first, you can't claim it as a QCD. There could be some ways to fix that, but a QCD is not included in your gross income. So that's huge, right? So you say, Uncle Sam, actually, I know I have to take $19,000 out, but I don't want to spend it or invest it. I want to give it away. It's going straight to the charity, the church, the charity. It's going straight there. And then Uncle Sam's like, oh, okay, I won't tax you on that money, right? You don't have to include it in your income. But you can't itemize a QCD as a charitable contribution, right? So if you claim the standard deduction and you don't itemize, it's pretty easy. You weren't going to claim it anyways, right? But you can't claim it as an itemized deduction. So the really big takeaway on this slide is the QCD is not included in your gross income. So if you wanted to write, $300 contribution to Hurricane Helene relief, right? $300 arguably wouldn't really reduce your taxable income, right? You just write that. But I think where this comes in handy is kind of more significant contributions where you're really going to reduce your taxable income, and it could, count against what you have to take from your required minimum distribution. So the QCD on your tax return, right? I told you that I like operations, and so the QCD, like, why can't I just write it from my checkbook? That's the same, right? The same result. But the reason the QCD you're going to get from your custodian, just your regular 1099-R, with all of your retirement plan distributions in one lump, okay? You'll report the full amount on line 4A on your tax return of all your IRA distributions or retirement plan distributions. And then on line 4B, you subtract out what is taxable, right? And so to tell the IRS why those two lines are different, you'll write QCD on it, right? So it's not included in your gross income. So for those of you that do your own taxes online, there's a little drop-down box to make it really easy for you to tell that it's a QCD. So before we move on to gifting appreciated stock, any questions on QCDs? Yeah.
Is this, can you do this 1 year at a time, or is a QCD like it's the rest of your life, or how does that work?
Fantastic question. 1 year at a time. And you can do multiple charities. So you don't have to say, like for that example where I showed you $19,000, you don't have to do $19,000 to one charity, and you don't have to do the full amount. You can do any amount you want to. So on your QCD form that you would get from your custodian, it'll have 8 lines where you would write the charity, church, address, and how much you want to send to that charity. And then they take care of that for you. So since your R&D has to be taken before the end of the year, if you want to do this, it'd be better to not do it in December when your custodian's probably really busy. They get it done for you, but just to get it taken care of before they're in crunch time. Yeah.
When you fill out those forms, QCD, can you set it up as a monthly or is it a one-time thing?
It's usually a one-time thing. I am sure you could set it up for monthly. Yeah.
Remind
Sure
me
you
again
could.
what a QDC is?
A qualified charitable distribution.
QDC.
Oh, your title's gone.
Oh, that's a typo. Qualified distribution is charitable. Yeah, I was, thank you.
And I don't know if anyone caught it, we had prayers for like 3 weeks in a row, PRAYERS. Like we had an extra R, PRAYE, PRAR, anyway. None of us saw that except Ed.
Yeah, what, could you explain maybe the difference between if I were to take the RMD and, as opposed to using the QCD approach, and then make a charitable deduction and simply deduct that off of my taxes as an itemized deduction with the other itemized deductions I have? What is the net difference from a
Yeah.
tax point of view?
Great question, and I wish I had put that as an example on the slide. Okay, so I'm gonna use very round numbers to make the math super easy. So let's say you have $50,000 in Social Security and pension income, right? And you have $50,000 as a required minimum distribution, right? Well, let's not say Social Security because that's taxed a little different. Okay, let's say you have income of 50,000 that's gonna be taxable and your required minimum distribution of $50,000. You have $100,000 of income that is taxed at ordinary income tax rate, right? Like maybe some of that is investment income would be taxed at capital gains, but ordinary income tax rates. And then you'd say, you know, I would make a $10,000 donation. So you write a check for $10,000. Your taxable income is $100,000 and you get to take a $10,000 charitable contribution deduction if you itemize your taxes. If you don't, you'll just get the standard deduction, right? But $100,000 is your taxable income. And you can only take up to 30% of your adjusted gross income as a charitable deduction. So you can only claim about 30,000. Yeah.
My children always want to be a QCD,
Yeah.
but they're not allowed.
They're not unless they're running a nonprofit that's a qualified charity, but they're not. Your kids are not. I like their thought pattern. So if you take instead, let's just say that $50,000 RMD, you do it all as a qualified charitable deduction, then your taxable income is only 50,000. Because you gave 50 entire thousand. Whoa, Uncle Sam, no, this is a qualified charitable deduction. I'm not touching it. It's not going to me, right? And so, your taxable income is just 50,000.
But if I had a situation where, putting the charitable deduction aside, I would itemize deductions due to other reasons, you know, whatever interest on mortgages or, you know, various other things that would force me to, or at least encourage me to not take the itemized deduction, but to take itemized deductions. And then on top of that, I add the $50,000 of charity via, you know, a check, et cetera, as you said. Wouldn't that be equivalent?
So, yeah, it would depend on where your tax rate is. So there's all kinds of fantastic online calculators that could help us do the math
Yeah,
really fast. But it would be the difference of not even having to be taxed on this money at all, or getting it as a deduction, right? So you're always gonna get more dollar for dollar to never even be taxed on it than just get a deduction off that dollar. Right? Yeah.
My mother does the QCD, but it's with Vanguard, but they send her the check and then she has to take it to the church.
Oh, okay. And they make the check, it says Vanguard
It's-
on the check and.
And it's made out to her church, but they don't mail it to her church. She has to take it.
Oh, that's very good to know. Right, so they're all gonna have, all these
Yeah.
different custodians will have nuances. That's really good to know. And so the charity will still send you a letter that says, thank you for your contribution, right? You'll still put with your tax return. It's documentation,
So
I'm sorry, I'm very simple-minded. So if I wanted to not write a check to PPC, but I wanted it to come through one of my, what did you call it? What was it?
Custodian, but
Custodians.
whatever, yeah, lots of words work.
I
for
go
that.
online, I get a form, and I tell them to send X amount of money to Tacoma Presbyterian Church.
Mhm.
And I never see that money. They
Mhm.
just deduct it from my account and it goes directly to PPC.
Mhm.
And again, to repeat, we can arrange to do that once a year or several times in installments, et
Mhm.
cetera.
Mhm.
But what I need to do is get that form.
Right, and you want to make sure you say, I want to do a qualified charitable deduction, right? Yes, and they can do that for you. You know, all of them might not offer it on a systematic basis. Some of them, because they're all going to have nuances, but you can ask them, right, if they'll do it as an installment for you.
I think you also, even in the charitable, distribution, you still need to get like the thank you note from them, just like all the rest of them.
You do, yeah. And so some of your custodians will also send you a letter that says, this is confirmation, because on that 1099-R form, you're not gonna see any difference. It's not gonna be broken down. The charity will still send you that letter, but also your custodian will probably send you a letter that says, this is confirmation of your charitable, qualified charitable deductions, so that you have that. I mean, some charities, you know, are a little slow on those letters. So a lot of the custodians also send you confirmation if you do it directly from them. Do you have any idea if your mom gets something like that from Vanguard?
I don't know, but she does it a couple times a year. It's more than once.
Yeah. So you do still need that, you know, confirmation. All right, so we talk about gifting appreciated stock, right? So we talked about retirement plans before, and all of that money went into the retirement plan pre-tax, because we're not talking about Roths or after tax today, right? So all of the money in a retirement plan that went in before tax comes out at ordinary tax rates. So when we talk about gifting appreciated stock, we're not talking about from a retirement plan. We're talking about from a brokerage account, right? And again, that word stock, you could put in mutual fund or investment, ETF, whatever word you want to put. All right, so capital gains rates are different from ordinary income tax rates, right? It's 0% if you have income below a certain threshold, 15%, or could be as high as 20%. So a lot lower than ordinary income tax rates. So let's say that we had $25,000 that we put into a stock, okay? And the current market value is $40,000. We've held this stock for a few years at least. So we have $15,000 of gains. The $25,000 is called our basis, and we're not taxed on that because we already were taxed on that, right? So $15,000 of gains, and let's say our long-term federal capital gains rate is 15%, okay? So if we sell the stock and then donate cash to the charity, we will pay capital gains tax on that $15,000. So $2,250, right? And then what we're going to give to our charity of choice is $12,750 because we sold the stock, so we paid the taxes on it, right? Or you could give the stock directly to the charity, and then you don't pay the capital gains tax on it, right? And so the contribution to the charity, they get $15,000, then they can sell it and they won't pay capital gains rates. So if you have a stock, if you invested in Amazon when it was still just an online bookstore, right? It is appreciated exponentially. You could give shares of your Amazon stock, right? You can say, I'm going to give 10 shares. You don't have to give the whole entire holding, right? You can just give parts of it. And charities will accept that. And again, the record keeper, custodian, they would facilitate that for you. Yeah.
Is that only for registered stock, or can you also donate unregistered stock?
You can donate unregistered stock, but you will have to have an appraised value for it, which can be harder to get, right? Because that's, the $40,000, that's the current fair market value. That's so easy to get, right? Every single day it's published. So for a stock that's, not publicly traded like that, you can definitely donate it. You just have to be able to have documentation of what that fair market value is at that time. But yes, absolutely. Yeah.
So then typically, if you gifted shares of the stock to, let's say, the church or what have you, I guess they would have the option, of continuing to hold it.
Yeah.
Or sell it and
Uh-huh.
realize it in the example that you've shown here, as well, right?
Yep, so they had total control. So you'd gift it away and you would have no control over what they did. So
Yeah,
if
right,
you
sure.
think this stock is gonna be worth $1 million, you gotta hold on to it. You have given it away and you don't have any control anymore.
Except maybe how they use it.
Perhaps, right, some influence. Yes, yes. All right, so the gifting of appreciated stock, the takeaways here are you eliminate capital gains for yourself. It's not on your tax return. So you take an immediate income tax deduction for the amount of the market value if you itemize your deductions, right? And so really when you gift appreciated stock, you're getting a double tax benefit because you're not paying the capital gains tax and you get to itemize that charitable contribution for the full market, for full charitable, full market value instead of just the after-tax amount, right? So a double tax benefit. Yeah.
And don't you get, hit by the 3% number, you can't get much more expensive stock. The way you're gonna be giving, a limit of 3% of your total income.
30%.
I do
30%, yep. So you could be very strategic about that. And you could look at your total income for the year and say, okay, I want to do 30% of my appreciated stock, right? And so every single year you could reconsider and recalculate that, right?
Yeah, so I assume then, the fair market value for the stock you take as a deduction on your income tax return, would be at the date the stock was gifted
Yes.
to, in other words, the date that it was actually transacted over to the charitable organization.
Yeah.
Is that correct?
That's correct,
Okay.
yeah.
So wherever it happens in the year, one has to, and maybe your custodian of your stocks or whatever
Mhm.
would automatically send you something that would say what that is, but you need to track it yourself as well, to make sure that that's the value that you use at the end of the year when you're filling out, the tax, or the following year for the previous year's tax return.
Yes, right, exactly. So you would give the stock, right? And the day that the, charity receives that stock, that's the amount that you're gonna get that letter for. Thank
It's
you for
value
your, yeah,
of deduction.
right. Yeah, exactly. So, questions you have? It could be outside of this too. It can be outside of QCDs and gifting appreciated stock.
What's the smallest QCD you can process?
Yeah, that's a great question. You could ask them to process anything, right? So I think really the benefit of doing a QCD is not for the $100 donations, right? The small ones, it's for ones that would actually have an impact of not being in your taxable income, but you can do it for anything, any amount.
And QCDs are only for RMDs and RMDs are only for a certain age.
Almost, you're in 2019, that would be absolutely exactly right. RMDs are only for a certain age and QCDs are only for people who are 70 and a half and older. And if you have to take an RMD, then your QCD will count, toward your RMD.
So minimum, you have to be 70 and a half and older to do RMDs or QCDs.
minimum, you have to be 70 and have to do a QCD. Now, depending on your year of birth, right, you won't have to take a required minimum distribution, right? And, you know, if you're born after 1960 until you're 75, but anybody who is 70 and a half or older can do the QCD. Because when the Secure Act 1.0 and 2.0 came out and they changed the required minimum distribution age, nobody touched the QCD age. So it got more complicated, right? I think it would have been easier for everybody if they just kept them in step together. Okay. So, you know, if you have a, you know, retirement account, and you just want to go ahead and start pulling money from it, right? You can do that you can do the QCD starting at age 70 and a half.
So, I mean, and another
Yeah.
way to just picking up on that, kind of the same question is then, RMDs, let's say, wouldn't be required for 74, so whatever your table says.
Mhm.
So before RMDs are required, and you don't need to pull money out for your lifestyle, but if you want to reduce your gross income,
Yeah,
you could pull money out for a QCD, and
well,
that would come off of your gross income.
it wouldn't reduce your gross income because it wouldn't add to it.
But you can't use it as a deduction either.
Right. So
So that's actually not a good thing. The example I just gave, I think, right?
it could be.
Because I would rather pull the money out
Mhm.
and get a tax benefit by deducting it on my income taxes and giving it to charity than pulling it out as a QCD and not being able to use it as a tax deduction for charity.
So let me give you one way that it would be very beneficial, okay? And this won't be everybody's reality, but if you always make charitable contributions that are equal to 30% of your gross income, and you want to do another significant charitable contribution, right? You could, the QCD is not going to ever be included in your taxable income, right? So you could do it in addition to.
I see.
Yeah.
What's the difference between a financial planner and a financial advisor?
Oh, great question. Usually, probably not much. A lot of financial advisors do financial planning. And so a lot of financial planners, well, okay, so, but what I would say is what I would expect a financial advisor to do is give you advice on investments, right?
That's your stockbroker,
Yeah, right, like a stockbroker.
okay?
Yeah, and all financial advisors don't do financial planning, and some do. And so then the nuance between a financial advisor and a financial planner is small. Most people who are a financial planner aren't like me, right? I just do financial planning and financial education, right? But I don't have my own book of clients. Most financial planners will do financial planning and investments and have, you know, their book of clients. Does that answer your question?
Maybe.
Yeah.
So is there a different qualification level, testing, certification, one versus the other?
Not unless they have an acronym behind their name. So anybody, could call themselves a financial advisor. Anybody could call themselves a financial planner. And then there's different acronyms, right? So like an accountant, isn't necessarily a CPA, but a CPA is definitely a CPA. You can't call yourself a CPA unless you have that designation, right?
Yeah, but to that same point, I know of situations where people call themselves, I don't know of this for financial planners, I think they're pretty much independent and are for your benefit. But I know of situations where there are financial advisors that are also connected in organizations that hawking certain investments. And so they get a commission. So the question that I think, at least from my standpoint, I would always ask for somebody, particularly a financial advisor, is how do you get money? Do you make money?
Yes, that's
Okay.
exactly what I was
And
gonna
so
say.
if they're somehow getting kickbacks for certain investments that they're kind of saying, hey, this is, and maybe they really believe it and maybe it is, but the point is they have a biased view when they're giving you advice potentially because some of their income is coming as commissioning associated with those investments as opposed to simply being made by, you know, the clients that they have that are, you know, providing them.
Yes, I always say, if you're interviewing for a financial advisor, financial planner, I always say, ask the question, how do you get paid? Right? Because it should be a question they're very comfortable answering, and commissions do not mean a bad thing. Commissions, right? Everybody, I also say, everybody gets paid. Everybody gets paid one way or another, so you can be a very honest and working in the best interest of your clients and get paid on commissions. But whoever you're working with or interviewing should be very upfront about how they get paid.
I'm not sure what I would do with the answer that I was given in that very same situation, because you just got through saying commissions are not a bad thing. I mean, because everybody's got to make money some kind of way. What is it you do not want to hear when you ask, how do you get paid?
Well,
Like Guido.
Yeah.
I would say somebody who deflected. Right, so we'll get to that. So back to the product that I wanted to pitch to you.
Okay, sure.
Right? We'll get to that later. I'll tell you that. I'll give it to you in a really long 15-page small print document that you can read on your own.
Okay.
That would be a red flag to me, right? Right, yeah.
Yeah, I just want to say, it might be ancient history, but when I worked at AT&T, the executives, one of the perks was they were given a financial planner
Yeah.
that was paid by the company. Now, unfortunately, I don't recall now what the qualifications were, but they did a great job. All right, and they looked at your personal income and, you know, your tax forms, et cetera, as well as what was in your investment accounts, and gave you some sound advice. Unfortunately, I lost that when I left, but I don't know if they still exist.
So I have seen that become a lot more common. So if you work for a company that offers benefits, right? You know, you're usually going to get a retirement plan and health insurance and dental and disability. And then sometimes you'll have like a flexible spending account. But a lot of the employers now are offering legal plans and then just kind of this hodgepodge of additional benefits. And if you dig into that, a lot of times they'll offer financial planning services through something just like that, Charlie. So a lot of times now, even it's for the masses, but you do kind of have to read through the whole benefits booklet to see if it's offered.
You had mentioned about that the QCD wasn't really meant for this, really for the smaller units, but it's say the difference between, say, giving 5 or say 10 $200 donations, QCDs, would be the same benefit as giving one, $2,000, I think. But I don't know if that's just more bookkeeping on your own behalf of giving smaller ones and then adding them up.
Yeah, so what you're saying is, all the small ones would add up to the same as kind of one larger. Yeah. So I think that's probably like a preference on if you want to give to a charity regular recurring, right? And probably the providers would do the installments, but I just think from my experience, most of the time the QCDs are done manually. And so, they're not going to want to do, if everybody at Vanguard did $100 monthly QCD, then they're hiring more staff to just process those because it is very manual typically.
They might give you a friendly call.
Yeah. Ask you if they could do it once a year instead of 12 times.
And don't wait till December.
Yeah.
But if you take your RMD in January versus in December, that if you think the market's going to go up during the year as you're pulling out of a recession, you might want to wait until December before you do your RMD, because your money you're taking out of it has a chance to grow for 12 more months before you take it out. You're gonna take the $1,000 out anyway, whether it's January or December.
Mhm. Yeah, and so there have been a couple of years where, the stock market has declined significantly, and the IRS has said, all right, we're waiving RMDs this year. And if you did take your RMD out in January, you're allowed to put it back in, even if it's December. So yes, you're right, yeah. But if you did and the IRS waived it that year, you could always put it back in. So any other questions?
Super informative, Catherine. Really, really.
I'll be happy to stay for questions afterwards.
And so this was sort of how to give, and next Sunday is why generosity. So that we're gonna be talking about sort of the theology behind it and the biblical injunctions on generosity. Yeah.
Great.
So, thank you so much.
Thank you.
Yeah, thanks everybody online.